Hi everyone, I'm Matt from Look Into Bitcoin, and today we're going to be looking at the employment rate and how it may be signaling for a recession. To do this, we'll be using a number of resources that are all freely available on lookintobitcoin.com, your number one source for Bitcoin information. And if you haven't already, don't forget to like the video, subscribe to the channel, and turn on notifications to ensure you're receiving all of our content as soon as it's released. So right now we're just on the Bitcoin live price page here on lookintobitcoin.com. And just to begin with, we're going to look at the correlation between Bitcoin and more traditional assets, such as US indexes, such as the S&P 500 and the Dow Jones, and a few stocks such as Tesla and Apple. Now, this correlation between Bitcoin and traditional US markets leads Bitcoin to potentially outperform these as a more speculative and volatile asset during the good times and the bull cycles, but this correlation also leads to potential more violent downwards price action when we see traditional markets potentially in a recession or more drawn out bear cycle period. So Bitcoin tends to, again, underperform during these periods. If we were to see a US market recession and potentially lower prices in these indexes and stocks, this may lead Bitcoin to have a little bit of underperformance to the downside. And specifically, we're going to be looking at the employment rate as a potential metric for spotting that a recession may be around the corner. If we just go to this article here, which is actually discussing the link between unemployment rates and recessions, an article here by the World Economic Forum, we can see here that as unemployment rate usually bottoms out, it usually coincides with a peak in an economy. So here, this is specifically looking at the US unemployment rate with the red recessionary zones marked here. And we can see as the unemployment rate reaches certain low levels, it usually precedes a recession and subsequently a drop in traditional market prices. So this goes into a few of the reasons why this may be the case. But if we just go onto a chart here, we can maybe just see the representation a little clearer. So this blue line here is indicating the unemployment rate in the US in percentage terms. So we can see right now it's sitting at about 3.6%. And this orange line is just the S&P 500 going back about 80 years. So a fair amount of data we have to work with here. And what we can do is if we just draw on this line here, which indicates a very low level of unemployment, this line is currently at 3.5%. And immediately you may think, a very low unemployment rate is actually very good for an economy. And this is true. Obviously, having lots of people in jobs definitely stimulates the economy and increases the velocity of money around the country. However, as we said, this usually coincides with the economy peaking because economies are cyclical. We have these boom and bust periods, and usually the worst times come after the best times. So we can see here in all of the S&P 500's history, once we see this unemployment rate dip this low, it usually precedes a decrease in asset prices. So here it did take a little bit before a decrease to the downside. And even if we didn't actually reach unemployment rates this low, we can see even if we see unemployment just start to bottom out and just maybe curl over and start increasing a little bit before these huge spikes to the upside, we can see that these always preceded a large decrease in prices in the US economy. So a lot of people are watching charts like this and other similar fundamental market metrics to try and gain some insight into if we are potentially leading into a recessionary period in the US economy and then subsequently, like we said, probably lower prices. So we can see here as we've just dipped right above this line here, we're just hovering about here. If we would see this start noticeably increasing, it may lead a lot of investors to potentially start pulling money into safer assets and leave more speculative markets such as stocks and equities, and of course even more speculative and volatile assets like cryptocurrencies. So if we were to see a recessionary period in traditional markets and lower prices on indexes such as the S&P 500, where could we potentially see Bitcoin dropping to given their correlation? Well, if we go to something like the price forecast tools here and just zoom in a little bit, we can see that this actually called the bottoming price action for Bitcoin, not only in this cycle, but in all previous cycles. So this CVDD line, which is the cumulative value of days destroyed, currently sits at about $18,000, but is always changing. And this orange line, which is the balance price, is just beneath $15,000. So these might not be bad spots to look at in a worst case situation. What we can do is look at some other on-chain metrics that may give us some indication. Something like the realized price, which gives us the average accumulation price of all holders currently on the network. So if we just scroll down the charts here, we can find the realized price. And this has been a great chart for distinguishing the tail end of a bear market. And once we subsequently cross above it, again, signals to us that potentially the new bull cycle has started. We could see in this most recent bear market that we did spend a prolonged period of time beneath this, but once we actually crossed back above, it really indicated that the bull market had commenced, or at least the transitionary period between bear and bull cycles. We even came back and retested it, which really solidifies the fact that this is a very crucial level for Bitcoin. And this has actually just started rising to the upside again, which is indicating potentially more people are happy to accumulate at higher prices. And this currently sits at just above $20,400, not too far above our previous all-time high at just beneath $20,000. So again, this might be a decent area to watch, especially right now as we're hovering around the 30k region. About a 33% drop here wouldn't be too great, but obviously it wouldn't be terrible. I think if we saw a prolonged decrease in US equities, then we have to be open potentially lower prices in the crypto markets. But what we also need to take into account is the fundamentals of Bitcoin as well, and the potential for a future decoupling in price action. So obviously we share a strong correlation with US markets right now, but something like the stock to flow model does have an impact on the Bitcoin price action, whether you believe in the potential valuations that are being forecasted with this model. It is something we have to take into account as something that is likely going to influence the decisions made by traders and investors. The stock to flow model is mapping out the future scarcity of Bitcoin as an asset as its future inflationary rates continue to decrease. And this next halvening will happen in just under a year, probably Q1 2024. So if we were to start to see a prolonged drawn out bear cycle in US equities, if the Bitcoin halvening coincides with that, we may begin to see this decoupling where even if Bitcoin isn't far outseeding performance and we're seeing price action like in the previous bull markets, maybe it'll just lead to a far outperformance of other assets such as US equities. But maybe we'd see more liquidity coming into the crypto markets as other things experience their own bear cycles. Who knows? It's all just speculation right now, but definitely keep an eye on the unemployment rate numbers. And if we start to see signs of that beginning to increase, it may be wise just to reel in the current market exposure you have. So just to summarize, historically, and what may initially seem counterintuitive, a very low unemployment rate has often preceded a traditional market recession. However, this is not always the case. There were a few instances in which this metric did not coincide with a negative market reaction. Potentially, we could see unemployment rates increase just slightly, just marginally to a healthy level, and potentially we don't see this really volatile boom-bust cycle in US markets. It's more of a gradual increase that doesn't have too much of an overriding impact. We also need to take into account that there are many other factors and influence that have an impact on asset prices, such as the money supply. For example, if we were to see a large injection of capital into the US markets as a result of alterations in central bank policies, this may lead to even higher asset prices, even in spite of rising unemployment rates, as a general increase in cash flow across an economy generally leads to higher asset prices. So they may negate each other. Again, we are just speculating here. But what we can say is Bitcoin does have a strong correlation to the US markets for the time being, and especially indexes such as the S&P 500. So a large decline would likely also result in a BTC price decrease, unless potentially Bitcoin fundamentals, such as the halving event, which is happening next year, kind of negate this, and we maybe don't see too much of a stark decrease in the Bitcoin price, and we finally get the Bitcoin decoupling that we've been hoping for a number of years now. If you liked this video, then please visit lookintobitcoin.com, where you can also consider becoming a site subscriber to get access to live charts, in-depth newsletters, indicator alerts, private TradingView strips, and more, all for a fraction of the standard industry price. And let me know in the comments down below and on social media, do you believe a rise in the unemployment rate will definitely lead to a decrease in traditional market prices? Or do you think that this metric is only just a result of other fundamental data points that maybe we didn't cover today? Whatever your thoughts are, let me know in the comments down below and on social media. Like I said, I look forward to reading and replying to all of them. Thank you very much for watching, and I'll see you in the next one.